What if money has no real value and central banks have lost their effectiveness? If, as it's been argued, countries globally are in a race to the bottom, each vying to have the weakest currency as a means of boosting trade, a currency war, in other words, what would you like to invest in if all of that is true? I'm Amanda Lang. Welcome to Bloomberg North. In terms of uncertainty, investors turn to safe havens like gold. There are those in government and financial circles who discredit the commodity, calling it a barbarous relic. Well, one of the world's best-known gold bulls says now is the time to buy it. And that's because we are on the verge of a monetary collapse, and gold will be the only currency left standing with any value. Jim Rickards, lawyer, portfolio manager, government advisor, lecturer, and author, has just released his latest book. It's called The New Case for Gold. It argues that countries around the world are buying gold at a fast pace now to prepare for the next collapse, when gold could be worth up to $10,000 an ounce. Jim Rickards is in Washington, D.C. Good to see you, Jim.
Great to see you, Amanda. Great to be with you.
So some people would describe this as the end of the world trade. If you're right, it means we're all living on canned goods in bunkers somewhere. How is that not the case? What are you describing?
Well, first of all, that's absolutely not correct. I've never said that. It's not the end of the world. It's not the apocalypse. We're not going to live in caves. The fact is the international monetary system has collapsed 3 times in the past 100 years. Look at the period from 1971 to 1980. Gold went from $35 an ounce to $800 an ounce. That's a 2,000% increase. It actually had nothing to do with gold. It had to do with the collapse of the dollar. That was an 80% devaluation of the dollar. In the 1930s, gold went from $20 an ounce to $35 an ounce, a 75% increase. Again, it had nothing to do with gold. It was a devaluation of the dollar. So you just have to ask yourself, is the U.S. dollar going to get stronger or weaker? If you think it's going to get stronger, you might not want gold. If you think it's going to get weaker, you definitely want gold. Gold is just a competing form of money.
So where in all of this, and you've written about, obviously, currency wars, the role of central banks, the failure, really, of central banks to play a meaningful role anymore. Where do they fit into this equation as you see gold hitting 10,000?
Well, you mentioned currency wars, Amanda, and that's exactly right. There's been a global currency war going on since 2010. Now, here's the problem with a currency war. Any country can get a temporary short-term advantage by devaluing its currency. That's actually true. But the problem is not everybody can devalue at once. Every currency can't devalue against every other currency at the same time. It's a mathematical impossibility. So if you want a weaker dollar to give the U.S. a lift, you're going to have a stronger euro. If you want a weaker dollar, you're going to have a stronger yen. That's what we're seeing right now. But, of course, the problem is that's temporary, and then the seesaw goes the other way. And you had the weak yen in 2013. You had the weak euro in 2015. Now it looks like we're in for the weak dollar. However, there is one currency, one form of money that every other currency can devalue against, which is gold, because gold can't fight back. Gold is not central bank money. It's just money. So at the end of the day, one of the ways you solve a currency war and get the inflation central banks are looking for is every currency can devalue against gold. That puts gold much higher, puts the dollar price of gold much higher. I would say, look, gold is gold. If I have an ounce at the beginning of the year, I stick it in a drawer, I come back a year later, I still have an ounce. It didn't go up or down. What happened was the dollar went up or down. So it's really about currencies.
So let's talk then about practicalities here, because when people talk about even a return to the gold standard, one of the first things that you will hear is there isn't enough of this stuff to actually back fiat currencies or to turn fiat currencies into that. What do you say to that?
Well, you know, actually in my book, The New Case for Gold, about 90% of it is an affirmative case for gold, but about 10% of it consists of knocking down those erroneous myths, and the one you just mentioned is one of them. When people say there's not enough gold to support the money system, it's nonsense. There's always enough gold. It's just a question of price. Now, if you went to a gold standard at today's price of $1,250 an ounce, that would be a blunder. It would be highly deflationary. But if you went to a gold standard at $10,000 an ounce, that would be mildly inflationary and would be very feasible. So it's not about the quantity of gold, it's about the price. You do have to get the price right. But to say there's not enough gold just means that whoever says that hasn't really thought much about the problem.
Are you predicting a dramatic collapse of the current system? If central banks are useless, if currencies need to go away, are we talking about real drama here?
Yeah, at the end of the day, that's absolutely right. When I say collapse of the system, what it means is it's a collapse of confidence. People say, you know, the Canadian dollar, the U.S. dollar, pound sterling, they're not backed by anything. Well, they are backed by one thing, which is confidence. If we all have confidence in it, but look what happened in 1977. The United States Treasury issued Treasury bonds, U.S. Treasury bonds, denominated in Swiss francs. They were the famous Carter bonds. So the U.S. government was borrowing in Swiss francs because people lacked confidence in the U.S. dollar. From 1977 to 1981, the U.S. had 50% inflation, 50. The value of the dollar was cut in half. So these episodes are not that rare. The next time it happens, people are going to go to gold because they'll be losing confidence in these paper currencies. At that point, again, Amanda, it's not the end of the world. What it means is that the major financial and trading powers come together, sit down around the table, as they did at the Plaza Accord in 1985, the Louvre Accord in 1987, Bretton Woods in 1984, Genoa in 1922. These conferences happen, and they reform the system. We're not there yet. We have to go through this collapse phase. But that's why you should get your gold now, because you won't be able to get it when the crisis comes.
So the major reorganizations, though, there were some minor ones, but Genoa and Bretton Woods happened after major world wars. Is there usually, or do you think, would you predict a major conflict that precedes the kind of reorganization that's required?
Well, there could be, but not necessarily. Again, you're right about Bretton Woods and Genoa, but the Plaza Accord, there was no world war then. I mean, it was the result of the U.S. having large budget deficits because of the Great Society in Vietnam, so there was war spending, but it wasn't the direct consequence of a war. So they're not directly correlated to wars, but that would be one of the things. Could be a natural disaster, could be social unrest, could be a lot of things, but basically it's something that triggers a collapse of confidence. And then, see, there's not a central bank in the world that wants a gold standard. You can be certain of that, but they may have to go to a gold standard even if they don't want it to restore confidence. What the International Monetary List, by the way, I'm here in Washington for the IMF spring meetings. You know, the G20 central bankers and finance ministers are all here. It's quite the powwow in Washington. But the IMF Global Elite Plan is a special drawing rights. That's a world money called the SDR for short that's printed by the IMF. The next crisis, it's going to be bigger than the central banks. They'll print trillions of SDRs and hand them out. It's just another form of printed money. We'll see if it works or not.
Okay, we've only got 30 seconds. Obviously, you're saying that investors should be buying gold. Typically, we've heard 5% of a portfolio. You say 10%.
Like it's a judgment. I recommend 10%. My view is if I'm completely wrong and gold goes down, you won't get hurt too badly with 10%. But if I'm right and it goes up, 2, 3, 4, 5 times, which I do expect, that will preserve your wealth. That will protect you against losses in the rest of your portfolio. But the point is, when the crisis comes, right, you're not going to be able to get gold. I just got back to Switzerland. It's already scarce.
All right. Jim Rickards, the new case for gold. Thanks.
Thanks.
Still ahead, could the rise of fintech upend the banking industry, or are those traditional institutions making the right investments right now in technology and talent? That's next.